Joining us now with his outlook for not just M&A, but let's talk credit markets, capital markets overall as we look to 2024. Tyler Dickson, head of investment banking and vice chairman of banking and international at Citi. Good to have you here.
Hey, always great to be here.
Let's start with M&A, try and get to some other things. I keep hearing and talking to the practitioners, hope. It's going to come. Are you amongst them? And if so, why?
I am. I think we're cautiously optimistic. I know you just cited the fact that we had a pretty slow November, but we had a near record October. And the M&A business and deal business, as you know, is lumpy. As we look forward, we get excited about the trends that we're seeing that are going to drive activity. First, I think equity volatility and credit volatility is stabilized. I think we've got a normalized outlook for the higher for longer interest rate environment. And with the CEOs and boards we're talking to, that's building some confidence. We also have activism coming our way as we reach the 2024 proxy window. We also are seeing with the financial sponsors both wanting to monetize assets and with over $1 trillion of dry powder being ready to act in 2024.
I mean, they've been sitting on a lot of stuff they want to, as you point out, sell and or potentially buy, although it's harder to get those returns when rates are as high as they are than perhaps they had been previously.
Well, look, I think people are starting to get comfortable that we may be at a peak in rates and that things may start to move in a positive direction. I think that gives us some confidence that debt markets and equity markets should be constructive in 2024.
Yeah. Regulation has also been an impediment potentially to deal making over, let's call it, the last couple of years. The fear that you're going to potentially get blocked or at least delayed by whether the FTC or the DOJ. How is that playing in boardrooms now? Is there more bravery, so to speak, amongst boards to say, we'll take them on?
Look, I think regulatory and geopolitical issues are always hard to fathom and calibrate, and they will always have an impact on big deal making. I think we would look towards some of the deals that have closed recently as evidence that big deal activity can go forward when it makes sense. So we'll look to sectors like technology, industrials, healthcare to be areas that we see being active in 2024 and 2025. And we've been lucky enough as we look at 2023 to be in some of the biggest deals in those categories.
Yeah, but why those industrial sectors?
Well, I think underneath it you have trends that we've talked about before, such as onshoring and friendshoring really driving activity in industrials and manufacturing. We look at technology and look at the amazing dislocations created by new technologies, AI, the cloud, digital infrastructure. We get excited about the future of healthcare and how that's changing dynamics. So those three megatrends are things that we think are going to influence 2024 and 2025 M&A activity, right. And they obviously had some influence on the low volumes we've seen so far this year.
Yeah, of course, the stock market, CEO confidence always plays an important role. Plus, sort of adjusting both sellers' expectations and what buyers are willing to do. Are we getting there?
Yeah, look, I think it's a process. Whenever you go through a very significant change in outlook for interest rates from 2021 to really 2022 and 2023, that adjustment is not a normal process. I think we're through the better part of it. I think we're in an environment now where you look at rate volatility and you look at the VIX equity volatility being really low. I think that gives confidence not on overall economic activity, but it creates a foundation for us to do more deals.
Yeah, all right, let's get to the credit markets themselves in terms of financing some of those deals. Are the financing markets open right now?
They are, and I think we've seen the debt markets be the most constructive markets in 2023. We'll see more of that in 2024. Investment grade has always had a strong bid, but I think when we look at the levered part of the markets, we see an opportunity, right? We see banks in a position to do syndicated lending. We see the private credit market be in a position to put money to work. When you look at the outlook for refinancing, you've got a big wall of maturities in 2025 through 2027. Maybe as much as $1 trillion that needs to be financed. And so we think both defensive financing and refinancing combined with new deal activity is going to make the acquisition finance market an investment grade and also the corporate and sponsor market in the less than investment grade category be a bit more active in 2024 than we saw in 2020.
You think so? But